This episode looks at delays to Trump's visit to Beijing for the China US summit, Indonesia resorting to government budget cuts to manage the deficit, US losing dominance as a global power, and rate decisions from the big four central banks. Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, the founding CEO of Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East Meets West podcast by Lundgren's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hello, Mel. How are you today, and how's your week been so far?
Hi, Peter, and hi to all our listeners. It's been an eventful week again. So, a lot of moving parts as far as global geopolitics and economic trends are concerned. We are closely watching several big decisions coming out of central banks, major central banks. So, we're looking towards an exciting week, though probably not at the same time. So, we'll talk about that in a bit. How about you, Peter? What have you been up to?
Yeah, it's busy. Of course, it is. The markets are busy again, as
Mm-hmm.
always, leading to more conversations with investors. That is natural. We have, of course, also, how to say it, more attention on what happens in respect of the funds that we are managing. It
Mm-hmm.
also takes more attention, simply as that. So this is a typical environment where the market as such keeps us busy. What are clients doing? Predominantly right now is more interest to our defense fund.
Yeah.
You would say it feels almost also a bit natural, yeah. But we have seen, as last week mentioned, also some shifts actually into Southeast Asia exposure.
Mm-hmm.
That's interesting. So yeah, let's jump into to the first topic, and it's we'll start with one of the very big players in the market, so to say, or countries. It's China.
So actually, Peter, they also have some things going on locally. If the world were going on minus the US waged war in Iran against Iran,
Mm,
Trump would have been, at least Trump's team would have been very busy preparing for his visit to Beijing. That was
mm,
supposed to be on the 31st of March, so 2 weeks from now. But
yeah,
now it seems they're changing plans. So of course, he's gonna focus on this war in Iran, and he's trying to actually use it as a, I'm not sure if it's leverage, but he's trying to
mm,
pressure China to come out and help with naval troops, naval defense in the Strait of Hormuz to push back against Iran, and saying that, yeah, I'm not gonna come there, but just help me out first. Trump or the US has made a similar appeal to US allies, so European Union, the UK, Japan, South Korea. And of course, it does not come as a shocker that these countries said, no, we're not going to do that just yet because
yeah,
yeah, the geopolitics is very tricky. And it
mm,
doesn't help that just about a year ago, he was sending higher tariffs left and right to these economies. And now you suddenly want
mm,
their help for a war that you started. But why? Why do you need it now? Because you started it. So that's the general sentiment that's coming out. But as far
mm,
as China and US relations, this trip would have been a milestone because the last time a US president was in China was also Trump in his first term. Biden never set foot there during his tenure. And then now it's an attempt to complete the trade negotiations from a year ago, from several postponements and delays. But
mm,
now it looks like it would be pushed back again. The Iran conflict is Trump's priority. He's trying to also paint it as, hey, you should come help out and send your naval ships here because it's energy security for all. Like, you're also affected. But at the same time, we know that Iran has been able, or China has been able to receive shipments of oil coming out of Iran. It's one of its biggest, if not the biggest, external source of fuel for the Chinese economy. So the ties are there. And so you can't really use that as a leverage for to convince China to join the chaos, so to speak. And China has been improving in terms of resilience. It has very ample stockpiles within the mainland. It has also reduced its reliance on crude oil in favor of renewable sources. So we know that
Yeah.
their electric vehicles renewable pivot has been more convenient more than ever. And yeah, in terms of positioning and China looks to be the more responsible economy right now as far as the scenario goes, and the US is getting the rejection from its allies because it's hard to balance the situation. Do you want to get on Trump's good side, but at the same time it's such a problematic position as well because you started it, so you go finish it, but that's not it looks now that they can't. So that's what we're looking out for. It's been 3 weeks and
Mhm.
he's been saying they won it on day one, but it's continuing. So you can't really claim
Mhm.
that now.
But as what you say about China is interesting. They have a pretty low oil dependence actually,
Mm-hmm.
but because they still have the a lot of the power what they produce is based on coal, or they can at any time use coal. That's of course not the best for sort of from a
The
green
environment.
perspective. Yeah. But anyway, they can, and then they have enormous oil or strategic reserves are
Mhm.
extremely big. They're really big.
Yes.
Even even for China, so that China is the second largest economy in the world. Even in that respect, they have extreme big reserves. As we have discussed, you, I, us internally, saying, okay, why is the Chinese stock market actually doing fantastic, stable, and doing fantastic well since US has attacked Iran?
Mm-hmm.
And one good explanation is actually that they do not have the same dependence on also a lot of green energy production. This is one of the reasons we see why the Chinese stock market is absolute stable so far during the war. It can change, but right now we are sort of pretty confident actually. Really interesting, and again we will revert a bit to China and sort of a bit even more discussion later. We need to cover another pretty important development in Indonesia.
Yes, Peter. So actually, the Indonesian government has been under fire over the last few weeks. We've talked about that, especially the concerns regarding credibility and transparency concerning stock market trades and ownership. Now it's getting dimmer, I guess, the prospects because the finance secretary wanted to relax a law that sets a cap on the budget deficit. So they've been mandated to keep it at 3% of GDP ever since the 2000s. In the aftermath of the Asian financial crisis, they've only relaxed it once during the COVID years. Understandably so, because they needed to spend more on social services. But now there is this pitch again because simply that oil is getting out of hand and they're a net importer. So while they do want to do something about it, they have not much leeway to do so. They've already been subsidizing retail fuel prices for so long. So that means an even bigger hit to public finances. But President Prabowo rejected that idea. He said it doesn't look like a crisis just yet. So he said the first response of the Indonesian government would be not to relax the deficit ceiling, but to cut budgets for government agencies. Well, sure, that sounds feasible, but at the same time, it is anti growth, especially if the cuts would be would mean lesser projects rolling out, fewer benefits given to their people, and there's only so much you can remove without
Mm.
without necessarily angering the people. And of course, another consideration would be, let's reduce the subsidies, but that would be the worst time to do it, especially when the public confidence towards the administration is declining, and when they're setting sights on a GDP target of as high as 8%. And clearly it's not the time to cut budgets, and it's also not a good idea politically to reduce any public benefits that people are enjoying. That would be like political suicide at this point. So it
Mhm.
is a tricky balance, but that's a very interesting response. Deficit ceilings, of course, would help to send out the message that, yeah, everything's in order, our fiscal house is in order, but at the same time the quality of the spending is in question, and if you sacrifice that, it could also be counterproductive.
Agree that Indonesia, we have been skeptical towards Indonesia since a long time, and it seems they will need to to comply with if they go for the 3% budget deficit max, yeah. That would be would have a negative impact on growth and the economy as such, yeah. And this is what we expect. It's not unhealthy, so to say, yeah, because
Yeah.
it is after all trying to control the public spending,
Mm-hmm.
but it could easily be have a negative effect on the stock market. So we said okay, they might come, but uh, there might be a weak period also in the Indonesian stock market. So we
It's
on
down right
wait.
now. Yeah.
We sort of we wait a bit and see what happens after the cuts has been made. We are much more in wait position, so we actually think it will go down. Yeah, that's the reaction. What we think.
Mm-hmm.
So this is it is interesting. Should be said, Indonesia is a bit on its own. Yeah, it's not representative for the whole Southeast Asia region.
Definitely.
The preconditions in Thailand are different,
Mm-hmm.
but it is a country also with a bit sort of that is a bit tricky and critical when it comes to growth and so
Mm-hmm.
it's not the same, but also maybe where we have an eye on. But in general, we're still happy for the growth outlook
Yes.
in the rest of yeah, Southeast Asia. Sort of to relate it to something authentical, authentic, or whatever we would say. We've just sort of been involved in some allocation towards Southeast Asia, Asia in general. We avoided Indonesia for the same reason in
Mm-hmm.
this allocation. For Southeast Asia, we actually went down on country level allocation where many would use a much broader instrument like an ETF or a fund, active traded fund for maybe a whole in Asia or what we would call Southeast Asia, China, whatever ASEAN. But we went a bit more actually down to country level, and
Mm-hmm.
Indonesia was one of the countries that we sort took away from the allocation. Just as an example on
Mm-hmm.
how
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 we're
yeah,
using this.
we actually also um, walk as we talk. Yeah,
Mm-hmm.
good. Let's jump to what is on the headline all the time. Yeah, and on taking the attention in the financial markets. That is the U.S. War against Iran,
Yes.
the U.S. Israel war against Iran, so to say. U.S. Combat forces, are they doing what they should do? Yeah, they are. They're doing what they've been asked to. Again, in a very fine way, they have taken over control as is, all of the airspace above Iran is under their control. They have bombed thousands and thousands of positions that are prove a danger to the world around Iran, and part of it is also nuclear production facilities. This was a part of the plan from the U.S. government or from Trump. Let's be honest, it probably his
Mm-hmm.
plan but it doesn't really cover the full outcome of happenings here. And now we have, as we discussed again last week and also the week before, there's a stress situation in Strait of Hormuz. The oil tankers cannot come through. This is generating a pressure. So far, you, I, Lord Queens,
Mm-hmm.
have said the world, the financial world, the stock markets, they can take the pressure with a oil price above 100 US dollar per barrel. But it will hurt economies in some time. No, it's still a shorter period, but of course we are fully aware of it. To try to quantify what do we think, as we see right now, the world and the market are still holding, still okay.
But not for
It
long.
won't, yeah, it's what we see. It's simply right now. Could we see it hold another week until the next podcast? Yes, we could. Um, but it is what we're trying to say. It is a situation is of course getting more stressed before it simply outright will hurt the
Mhm.
particular stock markets around the globe even more. It's not now. We cannot say how much longer, but so far we are holding in.
Mhm.
Also in our view about having risk on the books, but we can change that outlook any minute. That is for sure. Yeah. So it's probably how we see the situation.
I think,
Sort of.
Peter, a lot of the resilience of stock markets in general is, well, it's well within the supposed timeline that Trump has given so far. Like, it'll be a month. So we're 3 weeks in, and maybe that's one of the reasons why they're holding up just yet. But
Mm.
of course, as it gets prolonged, as the conflict gets prolonged with little progress on reopening the strait and resuming trade and shipment volumes as they were, that would probably even raise the volatility and the nervousness even more, and that could trigger deeper slides in stock valuations down the road.
Good. So, but it's how we judge the market right now. Are we nervous? No, but we are alert.
Yes.
The war gives reason to a lot of reflections. Yeah, a lot of things happened. There is one global sort of what could emerge into a global political factor. And this, of course, we noted that India was able to negotiate two tank ships, oil tankers getting out of the Hormuz Strait. Um, that can be a lonely story,
Mm-hmm.
but if it expands and all of a sudden if China can also get their oil tankers out, and India will get more out and more of the same, yeah, then it would be a disgrace for US. As a simply showing that US is what we've been talking about for a long time, not the political factor in global power as it used to be. But it would simply underline and stress how fast the sort of global political scene is moving. But we'll see if there's more to come. As in particular, if China starts to get oil tankers out of the Strait of Hormuz, it will be a disaster, a political disaster
It will be embarrassing, yeah.
yeah, it will really, really, really. So that we of course know does mean a lot for investors, not on today's stock market, but it means quite a lot strategically how we should consider the world. Yeah. Otherwise, around the world, Mel, we have the big four central banks.
Yes.
They're all in the market this week.
A lot of big decisions to be made, and well, we did hear that the Bank of Australia has hiked interest rates uh, on Tuesday, but at the same time, their inflation scenario isn't that favorable. Maybe that's why
Mhm.
the
Yeah.
hike pushed through, even with such a slim margin down the line vote. But for the Fed, especially, so we don't really see a rate cut or rate hike coming soon. We see a start of a pause for the year. That's what we had expected before, but now would be the more convincing time to do it, to do the pause.
Mhm. We see Australia not as a signaler, but bit more as a lonely rider, because it was
Mm-hmm.
actually the second time within two meetings
Yes.
they hiked. So it's a bit more in the cards. Concerning the big four central banks, Bank of Japan, Bank of England, ECB in Europe, and the Fed in Washington, we would be very surprised if they don't do as central bank normally do under these circumstances. As also we talked about last week, they will
Mm-hmm.
ensure there's enough liquidity in the market. There will be no squeeze for due to nervousness. So that's much more their position. But of course, there's no doubt they know that the higher oil price is absolutely equal to higher inflation.
Yes.
They know that. But it will also come down again. So we have raised some concerns, and that is natural. Of course, we need to look at the same headline as rest
Mhm.
of the world, because that is what is going on right now. It's most important is what's going on in the Middle East. Are there sunshine left at all if we look at our view, Mel?
Yes, of course, it is a much trickier scenario to assess. Each time there's always several moving parts to that mean a lot for investments and for economies, but we do still see that there are pockets of sunshine to look at, and we
Mhm.
remain overweight with risk. But although we do say that we like to take well considered risk, and for example, as with the discussion earlier about Indonesia and Southeast Asia, it pays to really scrutinize each economy, each market for idiosyncratic factors that, make or break your sentiment towards that part of the world. There are still high growth economies out there, and we particularly like those emerging Asia as well, particularly China, India, Malaysia for Southeast Asia is also promising, even
Yeah.
though of course everyone is ultimately hit by higher oil prices, Peter.
It is still general sunshine, we would say. Yeah.
Mhm.
It's
Yes.
this, the clouds, short-term clouds are a bit threatening. We actually stick to what we touched in the start of the podcast,
Mhm.
saying that the markets are actually very robust. In a fearful market or a bearish market, we would have seen the stock markets trading minus 15% now. This is one thing why we actually say, okay, we are still okay with overweight risk. We see the households in general around the world as still being
Oh.
okay, also in terms of desire to consume, and also you can say, okay, are they pressured on a higher oil price? Yeah, it can be, but the desire to consume is still there.
Mhm.
And that is also sort of keeping the global story a bit, I would say, intact. Um, and this is where we are still. So right now we are still okay, and we do see the sunshine.
Mhm.
We fully acknowledge that there are some short-term clouds here, but so far it is short-term. So thank you to the listeners, and also thank you to you, Mel, for sharing your insight.
Thank you, Peter, and thanks to our subscribers.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Longines Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts. Longines Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.